Is the trend changing? Janet Yellen says those magic words. What's up, everybody? Welcome aboard to Bubba's Bottom Line. It is Todd Bubba Horowitz. It is Sunday, August the 18th, as the year flies by and yields get smashed and the interest rates are going negative. It's quite the action that we have here. And of course, we've got action that suggests a very big moves coming in the markets. And this type of action usually suggests, when it happens at tops and bottoms of markets, that there's going to be a trend change, which we'll talk about later. But in the meantime, our good old friend Janet Yellen says that this time is different. Okay. Now we know that markets are never different. Everything always ends up the same way. Okay. This goes back, again, you can go back to Tulip Mania. You can go back to every major collapse in history. And the magic words that are always said right before the ending are, this time is different. And of course, the Fed, the ex-Fed chair, Janet Yellen, said that, well, because interest rates are so much lower this time, that this time is different. And of course, it is never different. Markets are markets. That's the way it is. And they work the same way. Nothing changes. This is not like the 90s, old economy, new economy. Okay. At the end of the day, companies have to make money. Earnings have to be there, which they're not. And we have to have some reasonable action, which we do not. Okay, you've got a race to the bottom in currencies. You've got a race to the bottom in yields, and nobody cares. I mean, we talk about that, the 100-year Austrian bond, which is, I think, now down to about 1 1/8. Okay, you've got the 30-year bonds under 3%. Under 2%. Okay, so again, you've got the yield curve inversion, but it's different this time. And of course, somebody told me they heard on one of the networks 4 different times from 4 different people that this time is different. Now you have to remember, as an investor, okay, that the people that are giving you the words on TV are the same people that are looking for you to keep your money in the market, because they get paid when your money is in the market. They do not get paid when you're sitting in cash. And I am not telling you to get out of the market, because we don't get out. Okay, and in fact, we hedge everything, so we're always 100% in the market. But as far as the market action, okay, it is never different. Okay, there's going to be a meltdown. It may be tomorrow, it may be a year from now. I can't tell you when that's going to be, but it will happen. It will always happen, because again, you get too well overinflated, and you've now got the boat almost fully loaded. All right, so we'll see what happens, but you can bet your ass that this will be, again, like it was in 08, like it was in 01, and every other collapse before. This will be like the Titanic, and people will be jumping off. So if you're preparing yourself now, A, by being hedged, so you don't have to worry about it, and B, by being smart about it, then you won't have anything to worry about, and you'll be able to actually benefit from the next major collapse. It's not about whether or not markets collapse. It's about whether you are prepared to handle the next collapse. That's the bigger key. Forget about all the predictions of when it's going to happen, and this is going to be that, and that. I don't care. Okay. At the end of the day, you come in, you trade. If you're a trader, you come in, you trade. If you're an investor, you figure out how to stay invested and how to protect what's in the market, so that you don't have to get out, and so that you have capital to go ahead and buy again. Okay. And that's what hedging does. And of course, next Saturday, we're having a hedging webinar, but we'll talk about that during the break. In the meantime, markets are never different. They work the same, because they work off of human emotion. That is not going to change. They can bring all the computers they want. They still got human beings pushing those buttons, okay? And that's what creates the high frequency. That's what creates everything. So forget about them talking about the algo traders and this trader and that trader, okay? At the end of the day, everything happens because everyday people are sitting at home, and they're typically all panicking at the same time, right? That doesn't change. So you think about it. When you get nervous, think about the other people around you, because one thing we have to understand about the investing and the trading world is what? This is a competition. This is a game. There are other people in the market at the same time. And if you're selling, there's somebody got to be buying, because that's how they make price discovery. For every buyer, there's got to be a seller, and for every seller, there's got to be a buyer. So somebody says that you're wrong. So you have to learn how to put the best probabilities in your favor. And one probability we know as a mathematical fact until this for 150 years is that the markets go up 8% to 8.5% year over year. They don't go up every year, but they do go up over history. They have gone up about 8%, 8.5% year over year. So again, if you're playing that as part of your strategy, and you're then playing to be able to hedge that strategy, then you're able to stay in markets at all times without worries. Okay, it's that simple. But the big story last week was the inversion of the yield curve. Well, we've been talking about the inversion of the yield curve for 6 months. Okay, this is not new and exciting to us. We saw it coming. We talked about it. We knew it was going to come. And of course, it created that little bit of a panic. But you have to remember that at this time of year, it is very thin. Markets are very quiet. Okay, so there is not a lot in the way of being able to stop the market from going in any direction. Hence the action you saw last week. There were much more volatile swings in price action because of the thinness in the market and the lack of true volume and activity. Now again, will that change? Yeah, we'll start to see after Labor Day. You will start to see more volume come into the market. You will start to see more action come into the market. And then we'll get a truer read of where we're actually going to go. But at the end, it does not matter, because what do we know also for a certainty is news doesn't make markets. Price makes market. Price discovery makes markets. So that is what makes the market. That is what tells you what the price is, which goes back to the theory that the market itself is always right. Okay, the market is never wrong. It never gets sick. It never gets tired. It is always right. So for you to say that it should go down here or it should go up here, you follow the market. That's how you put yourself in the best position. But the inversion of the yield curve is already old news, and it's probably going to get worse. Okay, so again, does that mean we're getting in a recession tomorrow? No, but I do personally think, which I've said here many times, I do believe we are in the very early stages of a recession. Now, recessions aren't one day and then they're over. They take time to start to build first. They don't just don't come. The problem is the economists that look at everything, they only know what their book says. They only know what they read in the library or that term paper they wrote for Princeton. Okay, they don't understand the real world of how it happens. So they won't tell you we had a recession until it's already long over. Right. The key is to identify when it's happening and when it's starting, okay, and how you're going to put yourself in the position to capitalize from that recession, not panic through that recession, okay. Again, I think one thing you look at as well is you look at different things that are going on, and we continue to hear about the tariffs and the retail cost. Now, again, I don't know what the tariffs have really cost. Okay, obviously I know the numbers that everybody states, but what do we know for sure? We know that the importing that we are doing has not changed. We are not paying more for imports because China continues to devalue the yuan, which makes our dollar stronger, which accommodates us on those tariffs. Okay. Now again, you can make all the excuses you want about that and how that works. At the end of the day, that's how it works. Okay. If my dollar bought 6 yuan, okay, a week ago, okay, and my tariff goes up 10%, now my dollar buys 7.2 yuan, well, guess what? I'm paying less now than I was before. So I say this, I cannot prove it, but again, I would bet on it, okay, that you're getting set up by these big companies to say that, hey, okay, we're going to have to raise prices, as soon as whenever. And of course, all that is a chance for them to improve their profit bottom line. Because again, I use the Starbucks example all the time, but today we'll use the gas companies. And if you recall, way back before we were self-producers of our own oil, and every time OPEC started up, we'd get these massive, gold oil went from 50 cents to 75 cents, right? I mean, that's how far back. I go back to when gas was 29 cents a gallon. But now you see they run them up, and then when they come down, they just don't come down far enough. Okay, so they've actually built in, and the big major crisis in the 80s, okay, ExxonMobil actually had their biggest profit quarter ever with all the complaining and crying they're doing. You're only getting set up for earnings blows when they tell you now of the potential problems that are going to be there. If you remember, not that long ago, it was always, Caterpillar missed earnings. What was because of the dollar? Well, certainly we could have hedged the dollar. So if they're really concerned about the dollar, they would have hedged it and there would have been no problem. But it gave them a built-in excuse as to why they missed earnings, just like we talk about with the weather and everything else. There's always an excuse why we didn't get a number. Okay. And of course, investors continue to fall for the same crap, the same trap regularly, that they believe they buy into this stuff. Okay. And of course, this is what creates the overall bubble and what we're seeing. And of course, the latest in our new venture is you've got the new mortgage deal. Okay. You can now get a 3.5% mortgage with a 580 credit score. And in fact, they'll even accommodate more, okay, to get the money out in the street. Now, again, didn't we just go through this with the lending, okay, with the banks, that you cannot give out money to people that can't pay it back? But of course, again, and if you've got a 580 credit score, it already indicates that you have trouble paying your bills, okay? So, but here we are, going to give new housing to people at 3.5%, okay, with a 580 credit score. Again, you tell me, does that not smell like a problem is coming down the road? And again, it may not be tomorrow. I'm not predicting. We don't predict, okay? We don't tell you what's going to happen. I give you an opinion from what I can see from my experience in the markets and from watching the tape and watching the action. But I can tell you, this is never good when they start to force money on people who can't afford it. But if you remember, okay, the United States is the one nation, okay, that is a by-the-month society, okay? So as you hear them talk about retail sales and how good everything and how confident the consumer is, well, again, consumer confidence, the last time it was as high was 2008, 2007. The last time it was as high was 2001. Well, we all know what the results were there. We are, by nature, a by-the-month society, instant gratification. And of course, if we got the money in our pocket, we're going to get it. So can I get that new car? Well, let's see, it's going to be $300 a month. I can afford $300 a month, okay? I can't afford to pay for it if something goes wrong. But right now, I can afford it. And that's, again, the same repeat that we see constantly, okay, is that if we can afford it now by the month, we're going to go ahead and buy it. And of course, that's what you see with all these things. So again, can I afford a house at 3.5%? Yeah. Okay. And then what happens if something changes, or I lose my job, or my pay changes? Because that goes back with this whole job thing now, as they're forcing wages higher through the government, which is stupid. Okay. But in the meantime, all they're doing then, that the employers are doing to accommodate, is they're cutting back on the number of hours that you can work. So again, it's the same old story. Okay. Price discovery would really set what wages could be, and they've gone up naturally by themselves without the help. And of course, that's what it should be. But of course, we have to have the government involved in trying to tell us what the minimum wage should be, which is another story for another day. In the meantime, does China care about any of this? And does China care about their people? And I would say the answer is no. Why would a communist country now care about what goes on? They're going to fight to the death here now. They're not going anywhere. And if their people have to suffer, the only people that really care are the oligarchs and the people with the big cash. But obviously, at a place the size of China, do you think they really care about the workers? And the answer, I would think, would be no. But we'll see how that plays out. In the meantime, this is Bubba's Bottom Line for Sunday, August the 18th. And of course, yesterday we did a great webinar on our our equity portfolio management with our algorithm. If you'd like to check it out, just email me at bub@bubbatrading.com. I'll be happy to send it to you. That product will be coming off the market because we're going to cut the number of members we're going to take now. We're running it until Monday night, tomorrow night at midnight, and then it's coming off the website and it will be taken down. But in the meantime, also, if you'd like to see how to hedge, we are going to do our hedging series starting next Saturday at noon Eastern. So you can go to bubbatrading.com and get the link for the hedging series, and you can start to check that out. In the meantime, don't forget about our high school program at Patreon, patreon.com/Bubba Trading. That's patreon.com/Bubba Trading. Now let's get back to Bubba's Bottom Line with me. Welcome back to Bubba's Bottom Line. Todd Bubba Horse with you on this fine Sunday, August the 18th. And of course, here we have a market that was, wow, it was wild, wasn't it? I mean, it was great action if you're ready for it. If you're not opinionated and you're not stubborn, it was great action. Now, we were long, we were short. We're short now. Okay, we're short equities right now, except for the NASDAQ. We're short the Dow, the S&P, and the Russell. Long the NASDAQ. Okay. And again, some days were painful, some days were not. And again, we don't worry about the day-to-day because we are playing and trading through a mechanical method, which is what we use in our portfolios and our futures. But in the meantime, so it'll be what it'll be, and we'll see. If it changes, we'll get long with the market. But what I'm really saying here is that at this wild price whip, up and down, because you saw it down big on Monday, came all the way back, and then Tuesday, and then Thursday was a big up day, and Friday. So we're having this wild up and down, big swings in markets. That is suggesting that the markets are getting ready to make a much bigger move, okay? And typically, it's suggesting a potential trend change, which means that we may start to trend lower. Now, again, we're not saying that it's going to trend lower because, again, we could certainly change and our algorithm could change, but based on our algorithms, based on what I see in the market, based on my 40 years, my educated guess is that the next move, the next trend will be down. Okay, you've already seen it. We peaked. We're starting to make higher lows. We're actually lower now than we were in June. So we've slowly come down after that recovery out of May. We've now slowly started to come down, and we're going into historically some weaker months. Now, again, we don't really play the historic card. I don't really care, but it is with combined with where our signals sit right now. Okay, to me, it looks like it could be lower. Now, if it turns around, hey, we'll turn around with it, and we will not fall off our chair if that is indeed the case. In the meantime, you've got oil, which is, we're long, unfortunately, but in the meantime, okay, oil remains in that, what we call that backwardation formation, which from a formation standpoint is very, very negative and very bearish to the oil market. And again, I'm hoping that our signal will change soon, but again, I do not argue with if I'm going to be mechanical, I have to be mechanical. I don't argue. But when you look at it, again, I hope it gets a big bounce, but if it doesn't, we'll obviously reverse. But again, when you look at the backwardation formation, which simply means that oil should be more expensive in the future, not cheaper. Okay. And right now, the December oil is about a 10% discount to October oil, which is the backwards formation, which makes backwardation. Okay. And that is not healthy as a rule, because if you look at every other major backwardation history, it usually ends up in crumbling. And again, I would not be surprised. Again, I'm still personally looking for the 40s. Now, it may go to 60 first. I would highly doubt it. But again, I can't say it won't. But certainly, I'm looking for the 40s and potentially lower as we get further into this cycle. And we'll see how it plays out. You've got, Saudi Arabia. You've got the fear going on with Iran. But Iran did release one of the ships. So that takes care of that part of it. And things in the Mideast have seemed to calm down a little bit. So we'll see how that plays out. In the meantime, bonds continue to explode to the upside, pushing yields obviously lower, which caused the inversion of the curve. But bonds are at all-time highs. Yields are at all-time lows. And of course, this is courtesy of your Federal Reserve, who continues to accommodate for whatever reason. And I thought last week you might have seen an early rate cut. I thought you might have seen an emergency, but of course, the markets came back and accommodated Wednesday's 800-point down day with a big rally. So that gave the accommodation to say, okay, we're going to now, not have to worry about it, which is what they don't have to worry as long as if the markets are going down again, another 5, 6, 7, 800 on Thursday, I believe you would have had a rate cut by Friday. Okay. Now we know for sure the meeting in September is going to have a rate cut to it. The only question is it going to be 25 basis points or is it going to be 50? And that, of course, part of that reason, and I will give them a slight pass as much as it pains me, because unfortunately, the rest of the world continues to tank their own rates, their own currency. So what the Fed's trying to do now is trying to keep up. Okay. And of course, this is the ridiculous broken down Japan model that started when they overpaid for Pebble Beach in the 90s. But again, so look for bonds to keep going higher. We've been long them for, I don't know, 9 or 10 points, and we're not getting out now. Okay. And again, that could change. But for now, bonds go up. Okay. Gold continues. Again, there's like no stopping the gold market at this time. Again, every market will find the level in which it will fail, either whether it's going up or whether it's going down. But right now, gold looks like it wants to go. Our target right now is 1,600. Okay, that's what I've been writing for Kitco, and I expect to see 1,600. Again, I'm not expecting to see it tomorrow. I just believe that 1,500 will hold. We're long. We've been long, and I continue to see and expect the rally to continue. Because some people use it as a fear trade. Okay. It's also could be a currency trade. It could be an interest rate, whatever trade it's for. Right now, it's in demand. And if you look at it, gold has actually outperformed the S&P so far in 2019. Now, again, I believe you should have them both. Okay. Again, in my personal opinion, gold is nothing more than a hard asset commodity. Okay. But I do think that everyone's portfolio should have a representation of some, 5%, 6%. 10% of gold, whatever, a number, something I believe in the equities more than anything, especially because I can hedge them to a mathematical certainty and control my risk. But again, I believe that you should all own a little bit of gold. And I think silver is getting ready to look like it wants to break to the upside as well. Now, gold is on 6-year highs. Silver is just on 1-year highs. And interestingly enough, the gold-silver ratio is 90-1. Okay. Now, in the original mandate, when metals were the standard, okay, the ratio it was supposed to be no more than 15-1. So something has happened somewhere, right? And of course, you're also seeing the Bitcoin, which you talked about, right? And Bitcoin and the cryptos are back over 10,000. They got up to 13, went back down to about 9. Now they're back over 10. They're going higher. Okay. And again, I don't like to see them when they explode in one direction. I like to see the steadier move. But remember, with some of the world turmoil, okay, you can't just leave a country, especially a communist country, with 1,000 ounces of gold. Okay, so if you want to get your money out of the country, you're going to have to figure out a way to get it out, and the only way to get it out is through the crypto world. So think about that. That will create and has created, I think, some more demand for the crypto space and the currencies. And the other thing is all of this central bank intervention. The cryptos are a free market environment. Okay, so they will continue to grow. Again, I don't want them to surge out. They will continue to grow and be a part. And the more the Fed and other central banks fight against the cryptocurrency world, the more viable they become, because they're telling you that gets in their way of manipulating and creating what they've created over the last 106 years, which is a pile of garbage. Okay, so grain markets. Last Monday was the USDA report. Phew. Bing. Now we're short, so it's okay. But again, I didn't see a fall this big. Okay, but again, corn got hammered, soybeans got hurt, and wheat's down around the bottom. Again, I would expect to see these to start to hold here. Again, we're still short, but again, I would expect to see a hold here fairly soon, and I would then expect to see a potential big rally. I still think that we've got the opportunity for a big market in the grains. And again, we're short. So again, I'm telling you exactly where I stand, but I'm also telling you what I think here. And I do see that as a very good potential once we get through this period right here, because I think we're going to find out that there's some other issues that aren't being taken, and it has nothing to do with the tariffs. And of course, cattle. Whoa. Now, very interesting action in cattle. If you look at live cattle and feeder cattle, okay. Last Friday, a week ago, there was a fire at the Tyson plant. And of course, Monday morning when the markets opened, both live cattle and feeder cattle went down limit, okay, and got creamed, okay. Now, they expand limits, and on Tuesday, both went down limit, except that feeders were able to recover a little bit. And then by Wednesday, they both started to recover, but feeders actually went up the limit, okay. And feeders have actually worked themselves back into a very solid consolidating formation back to where they were. So they recovered everything and now look like they're ready to go higher. I think live cattle will find a spot here, and you'll see a pretty sharp rally a couple of days this week. And I would expect them to start going back in. And hogs looked like they were finding some support and then kind of got popped on Friday. But it looks to me hogs probably are heading potentially higher. So again, I think that, the ag space itself, although we're short a lot of it, would looks like it should be getting ready to turn around, and we'll see and play it by ear. In the meantime, remember this: it is never different. I don't care what Janet Yellen says. I don't care what any of them say. Markets are never different. They've traded the same way. They will continue to trade the same way. We're going to step out here for a break. This is Bubba's Bottom Line, Todd Bubba Horowitz, and we're going to come back with my commentary after the break, right here on Bubba's Bottom Line, Sunday, August the 18th. Well, folks, I did a great webinar yesterday for equity portfolios, and certainly if you'd like to listen to it and check it out, you can, because after tomorrow night at midnight, that product comes off my website. It will no longer be available to the public for sale. But certainly if you'd like to check it out, you can get it now and see the recording. And also this Saturday coming forward, our hedging program, which we talk about often here, how to protect your portfolio. You want to protect your assets. You want to stay in the market and benefit from the next collapse. Come see me Saturday at noon Eastern. You can get the link off the website at bubbatrading.com. And of course, don't forget about our high school investing program. You can go to Patreon, patreon.com/Bubba Trading, and help us out. In the meantime, let's get back to Bubba's Bottom Line and my commentary right now. Welcome back, everybody. This is Bubba's Bottom Line. I am Todd Bubba Horowitz, and it is Sunday, August the 18th. So, obviously, a crazy week in the markets this week, and boy, the media coverage was absolutely brutal. Okay, I got to tell you, it is embarrassing to watch some of these people talk about markets that have no idea how the markets even function, and start to figure out to make excuses for, well, this happened here, and now this is happening, and they try to justify their careers of why they're on air when they have no idea how the markets function to begin with. You had many of them starting to talk about this time is different, and then you had one of them on Friday saying, well, this big rally just came because the chairman of Bank of America says he doesn't see a recession. Okay. Now, nobody's calling for a recession. So you think the markets actually rallied 500 because the chairman of Bank of America said he doesn't see a recession? The markets rallied because they were, coming off of a dead cat bounce. They were looking for a reason to rally, and they cut everybody short, okay? Because there was more action around the globe. Again, there isn't a specific reason why markets do what they do. The news is well played out long before. If you try to trade off of what you hear on any of the major networks, CNBC, Fox, Bloomberg, you lose automatically. You have no chance, okay? If you try to trade the news that you hear on air, you have zero chance to ever make any money, okay? Why? Because that news is old news already. Remember, the big firms, Goldman Sachs, JP Morgan, Citibank, they're paying millions and billions of dollars a year to have their people reading that ticker tape, and they're ahead of the news, okay? There used to be an organization, Need to Know News, okay, which was actually an arm of Deutsche Bank that was used to get in these meetings and somehow get the information out early. But their coverage is brutal. They have no understanding of the market. So please do yourself a favor, okay? And do not, you obviously want to listen to entertainment, which is really all it is, because they're all clueless. Okay, again, talking about they know what the yield curve is. And this is because there is never a reason. The markets trade on price discovery. They move up and down, and by the time you see them tell you something, it's already done. Okay, so we can't justify any particular reason. Okay, other than if there's a fundamental news bomb, what we call, okay, like the Tyson fire. Okay, that was something that nobody could ever price in, nobody could account for, so cattle got clobbered. Okay, but unless there is an event like that in the equities are going to trade back and forth, and they'll figure out the next trend after they break out of this consolidation range. But in the meantime, the market, the pundits try to make it too confusing. They try to convince you that you got to be moving your portfolio all the time. Incorrect. Stick with what you got. Good, solid companies. You'll be fine. Don't try to chase and time the market, because it cannot be timed by anybody successfully. And of course, again, as I say, they are mostly clueless, have no idea how markets work, they have no idea how markets function, but will continue to report ridiculous, bogus, BS garbage. This is Todd Bubba Horowitz, Bubba's Bottom Line. Have a great weekend, everybody. As always, I thank you so much for being a part of the show. We'll see you back here tomorrow with Bubba's Daily Update, but of course, next Sunday with Bubba's Bottom Line. Have a great weekend, everybody. Thanks so much. We'll see you later.